Coming up in today's show, the Dow closes up for the 9th day in a row while mega-cap tech sells off hard. US home sales are the lowest in 14 years. Jobless claims come in lower than expected. Tesla drops almost 10% after earnings. The largest chip maker in the world sees sales fall. And the $10 quillion asteroid. Welcome back to the Click Capital Daily Show, everybody. My name's Jared, and I'm going to run you through the most important news, data, and charts from the markets today. And a bit of an interesting day we had here. You can see by all the red here how much mega-cap tech sold off really hard. Netflix down 8%, Google down 2.2%, NVDA down 3.3%, and the big one, Tesla, down 9.7%. And once again, a bifurcated market. We got the strength and defensive stuff like healthcare, consumer defensive, utilities, and even the value sectors like finance and energy's caught a bid. And just like this heat map shows here, can just show you what a tale of two markets it truly is. It's almost like two different stock markets, the mega cap tech, semis, and then the rest of the market. And so stick with me right through the end. I'm going to go through all the news and charts, and we're going to see whether this is the start of a bigger pullback in the NASDAQ and those growth stocks, or is this just another buy the dip opportunity? And we can see that big divergence in the indices today on the charts, with the Dow finishing up 0.5% and the NASDAQ finishing down 2.3%. And that was actually the second biggest fall for the NASDAQ all year. Just after back in February, we got a 2.37% fall back then. So not far behind that, almost the biggest fall for the year and on above average volume. So a clear sell-off into mega cap tech, and stick with me, I'll get more into this on the charts later. First, we'll go through all the news out there. And so we got some housing data in today that showed home sales just dropped to a 14-year low as buyers face a shortage of inventory. We also saw existing home sales slump 3.3% over the past month, and that's a 19% decline from the 5 million homes reported in June last year. And this is what's really holding the housing market up, is the lack of inventory out there, as most people have locked in low long-term rates, and if they sell, they'll have to refinance at the much higher current rates on offer. However, there is almost a quarter of mortgages out there that will reset over the next couple of years, and they will go into a much higher mortgage repayment, and no doubt will cause an increase in supply in the market. And if you pair that with a recession at some point over the next year or two, that could cause a really sharp reversion in the mean of the cost to buy versus the cost to rent, and bring down US home values along with it. And it's much the story around the rest of the world, with prices even more exacerbated in countries like Canada and much of the other Western countries as well. UK, Australia, New Zealand all have very high elevated home prices. And we can see that in this chart here of US home values. The average home value has increased a lot faster and higher than the median household income, and this is pretty much the same story in every Western country. When you look at the ratio of the average house price to the average salary, it's at record highs, meaning housing affordability is at its worst, and that's why a lot of millennials are struggling to buy their home. And you got to wonder, how much further can this trend keep on going with the average price of a house versus salary? Also out today, we've got a top economist saying the stock market mania reminds him a lot of the dot-com and housing bubbles, and warns consumers are feeling the squeeze. And that's David Rosenberg, who runs his own research house, and he was one of the first to sound the alarm bells on the housing market back in 2005. And like other long-term finance observers, he too is saying now is a similar mania to before past crashes like the Great Crash of 29, the dot-com bubble in 2000. And he's noted that American consumers are running short of cash and struggling to borrow more, as we're already seeing a tightening of credit in the economy. And so it's not a good sign when we've got record low unemployment rate, and a lot of people are already running out of savings. As we can see in this chart here, which shows the likelihood of coming up with $2,000 within the next month, minus the likelihood of needing that $2,000, and that's the lowest on record, meaning most consumers' liquidity is the most vulnerable it's ever been, and that's why we've got record low unemployment rate. And the jobs market is continuing to hold up well. We saw that today with initial jobless claims coming in lower than expected at 228,000 versus the 242,000 analysts were expecting. And that caused a little bit of a repricing in the bond market today, as they're seeing that strength in the labor market as a good reason for the Fed to possibly do a second hike in September or November. And we can see that in the Fed fund futures market, with the hike next Wednesday pretty much a given. And the odds will get another hike in September, increasing today to almost 18% from 13.9% yesterday. And the market's now saying there's a 29% chance they'll have done a second hike by November. So it's likely the Fed will raise next Wednesday, then they may go ahead with this pause and hike kind of policy, kind of a slower path to hiking, to let those hikes play out through the economy more slowly. So they may pause again in September and then raise again in November if we're still seeing a tight jobs market and if we don't see inflation moving down much more. Remember, we've still got core inflation around 5%, more than double the Fed's target. So that's still good reason for them to keep hiking rates. And there's an interesting point out from David Rubenstein today, a billionaire who runs one of the largest private equity firms in the world. And he said there's only one solution to US debt. That's more inflation. He said because the US won't cut spending, they won't raise taxes much, they won't seek a bailout, and definitely don't want to default on their debt. So the only way to get out is inflate your way out. But he noted that will exacerbate income inequality. And one of the reasons we may not have got a recession yet is something that is different this time compared to history, is we've had a lot of big companies fix their rate at low levels, much like the consumer has done with their mortgages. Because looking back in history, normally when interest rates rise, so do debt repayments, which squeezes profit margins and slows the economy. However, now when we look at the debt composition of the S&P 500 companies, just 6% of that debt is in short-term floating rates, 8% is in long-term floating, 10% is in short-term fixed, and a huge 76% is in long-term fixed debt. So that's helped companies keep their interest repayments low and benefit from the inflation with their pricing power and margins. However, like the mortgage market, the commercial real estate market, junk bonds, a lot of investment grade debt is going to mature in 25, 26, and 27. And if interest rates are not lower by then they're going to have to refinance at a lot higher. So the Fed's going to really want to get inflation down before 25, along with interest rates, so companies can refix their debt at low rates again and keep the party going. One of the big news stories out today was Tesla dropping almost 10% after we got earnings from them yesterday afternoon. They did disappoint a little bit on their margins. However, profits were still up a whopping 45% year over year, which is a massive increase for an $800 billion company. And just looking at the charts, it's no surprise to see a bit of a correction here after we've been on such a great run since those lows below $100 a share at the start of the year. We touched almost $300 in yesterday's session. And so it's not all that surprising to see a bit of profit taking here. And we'll see whether going into the weekend and next week we can hold on to the 50-day VWAP. But it shouldn't be surprising at all to see it come down and at least test $240 a share. However, not only Tesla is growing deliveries of their most popular models 3 and Y, there's also other catalysts coming up for the stock this year, and that's Cybertruck. And going into next year and beyond is the full self-driving FSD, which, like this analyst notes, could add $20 billion a year in revenue. And just like Tesla owns the industry with their supercharger network and every other big brand jumping on board with agreements with them, they may do the same thing with their FSD software and license out the technology, since they are at least 5 to 7 years ahead of the industry in terms of technology, infrastructure, and profit margins. And so automated cars will arrive, Tesla will be the leader, and they'll eventually get robo-taxis out there, and this is probably the biggest catalyst for them over the next couple of years or so. So I'm a long-term Tesla holder, and I would love the opportunity to reload back below $200 a share if possible. So hopefully this pullback correction keeps going, and we can dip down below there and take advantage of those prices. However, I don't think we'll ever see $100 again. I think the odds of that happening is very low. And if we ever did get down there, I would be backing the truck up to load as much as I can. The other big one out today was the biggest semiconductor manufacturer in the world, Taiwan Semi. Came in with a bit of a surprise and said it expected second quarter revenue of between 15.2 and 16 billion. That's down from 18.1 billion a year earlier. And even though they've seen a decrease in sales, they're going to leave their capex the same and keep a high level of spending in anticipation of a pickup in orders in the second half of the year. And so this kind of just flies in the face of a new AI chip boom. And you're seeing the biggest chip maker in the world with contracting revenue. And we can see that in the charts today. Market bringing down the shares 5% and the whole semi sector with it down 3.5%, along with the most valued semi stock in the world, NVDA as well, down 3.3%. And off another 1.1% after hours as I speak. We also got one asset manager saying today crypto is at the early stage of a 3-year bull market. And that's Chief Executive of Bitwise Asset Manager, crypto-focused firm with $1 billion in assets. Said historically crypto could be broken down into several 4-year cycles. Historically, Bitcoin and the crypto space are up for 3 years, and then it has a bear market, seeing a drawdown of usually 60 to 70%. So each bull market usually has a different catalysts, with the first being Bitcoin's creation in 2009, the second being Ether's launch in 2015, and the third being the boost from different application of blockchains from 2019. He said in this cycle, institutional mainstream counterparties, consumer use cases, wider adoption, where the number of users of decentralized applications goes from 5 to 10 million range towards 100 million, could be the catalyst of this next bull market. However, on the other side of that, we've got the government, like the Fed and the SEC, trying to shut down crypto, and the Fed's actually launched a new payment system that lets you send money in seconds the same way that crypto does, and one of the biggest advantages of crypto over traditional finance. And that's with the Fed Now system, which isn't offered directly to individuals and businesses, but it will serve as a basis of infrastructure for instant payments by linking banks. So soon when you do a transfer online to your bank to anyone else, over the coming year or two, that'll be pretty much instant. And that's one of the good things I see from crypto, is it's helping traditional finance stay on their toes, keep them honest, and improve, as it's creating good competition in the finance system overall. And so if we see the Fed and traditional finance and banks take away all those advantages that crypto has, then the SEC chair Gary Gensler may get his way, and how he views crypto as the Wild West, and wants an increase in his agency budget to kind of go after it, to shut it down and allow his buddies and traditional finance to step in and take over. And just looking at the price of Bitcoin, we can see it's just pulling back from this big 31,000 resistance zone. And just looking at a chart of the total crypto market cap, we're just sitting a bit over 1.1 trillion, and that's still well off the 3 trillion market cap. The crypto market hit almost to the tick back in November 2021 before reversing course. So technically speaking, I wouldn't call the crypto market a bull market here. However, it may be a little stretch to call it a bear market. I think we could call this a sideways market for now until we well and truly break out above these levels and see some high highs and high lows. It's still yet to be seen whether crypto is going into a bull market here. And just a little bit of interesting news for you here on this Thursday. NASA's just cleared key hurdles that allow it to launch a spacecraft to an asteroid in between Mars and Jupiter that is thought to be made up of gold, iron, and nickel, valued at an estimated $10 quintillion. And so they're launching that with a SpaceX rocket. They said they'll get there in just under 100 days, and this could potentially be a big game changer for industry and society as a whole, as the government's already back in 2015 with their US Commercial Space Launch Competitiveness Act gives companies legal right to any materials they mine from celestial bodies. And so you can just imagine in the future, space mining will become an industry and could have a huge change on us all in many ways. And in another sign, this market can't be held down for long, as even though the NASDAQ had its second biggest down day for the year, we've still got the Fear and Greed Index at a very elevated 80 level. And that's largely thanks to a still very active options market, very busy for a Thursday, almost 45 million contracts traded, and still very lopsided here with 58% of them calls. But once again, dark pool traders are not really interested in this market up here. And we did see a bit of an uptick in corporate insider activity yesterday, but we've still got sales outstripping purchases more than 2 to 1. Okay, back into the charts, and stick with me as I'll give you my final thoughts on the main indices at the end of this video. First, we'll just go through all the most other important markets today, including international stock indices, which still are a little muted here. Only got a little bit of a bump up in volatility today. Still got the VIX under 14. Although we've got NASDAQ volatility, the VXN a little bit higher at 20.2. Again, wasn't a huge bump up today. And the volatility term structure is still in a normal contango curve where we've got up the front lower than out the back. So right now the market isn't pricing in a big correction or crash. And with that VIX at 14, that's a volatility market options deal is pretty much telling us that this is likely to be another buy the dip opportunity. You can see that and volatility risk premium as well, not jumping much, just at 4.7 points above realized, and the skew market hasn't dropped as well. So the price of out of the money put options is still elevated, and just taking you out to a weekly chart, that typically drops after we've had the correction in the market and is elevated going into the correction. Another thing to note is even though we've had sharp pullbacks in tech and growth stocks, that didn't spill over to the rest of the market. In fact, the rest of the market's still holding up really well. It's still got 82% of stocks above their 20-day average, and the amount of stocks making new highs is still holding up and easily eclipsing stocks making new lows. However, what was of note today was the price action in the growth versus defensive sectors. Bit of a sharp rotation here. We can see that in growth versus defensive ETFs coming down a huge 3.4%. Same with high beta stocks versus low volatility stocks. Bit of a sharp sell-off there. And before you know it, the growth versus value stock spread is already underneath its 50-day VWAP for the first time since late April. And we've got commodities versus stocks jumping above their 50-day VWAP, and high-yield bonds are still trending up versus treasuries. There's that jump up in inflation expectations today on the back of that good jobless claims number, which helps see a little bit of a bump up in the 2-year government bond yield to 484, and the December Fed Fund futures contract is still holding up there at 539. As higher bond yields brought TLT back a bit here and helped the dollar index climb back above 100. And even with that stronger dollar and yields, we still saw a bit of a tick up in the commodity complex, with gold still hovering just under 2,000 an ounce and crude still holding above 75 a barrel. Over to stock sectors, and as we can see, a lot of red in all the sectors that have been performing well, especially the overvalued stuff like ARK came off 5.7%, consumer discretionary was down 3.4%, home builders, which have been on a tear, put in a bit of a reversal candle, gold miners came off a lot harder than the price of gold, and then in a sign of that rotation, the winning sector today was utilities. Really strong price action here, up 1.8%. Same with healthcare as well. We got some good earnings coming out of some healthcare companies. sent the sector up 1.66%. And just a quick look at our sector trends table indicator. We can see there's a bit of a red developing up the front here, even in the SPY and Qs, discretionary, tech, communication, AI bots and semis, all underneath their 5-day moving average. However, we've still got every sector above their 20-day moving average, and all but biotech above their 50-day moving average. So the short and medium-term trends are still up. We've just got a bit of weakness here in the immediate trend, and most sectors are still above their long-term 200-day moving average as well. There's BlackRock continuing to tick up higher, and JP Morgan as well, up 1.2%. And it looks like we've done a clean breakout of this level, did a little bit of a retracement and quickly got back above it. And we can see now we've got a nice open wave flow, and price looks to be walking the line of the top of our buy-sell band. So in this instance here, this is when you don't want to fade the move and you don't want to fight this momentum. Whenever you see price hug the band like that, even though the DSI is overbought, I wouldn't fade this move because we can see now on our range strength we've gone red, which means the price is now trending. And like I've been saying since back here, I had a feeling JP Morgan was going to break out and run because it's good valuation and rates are moving higher and the economy's still holding up, and they came in with good earnings to kind of just add to all of that. So this may be the start of a new rotation into the energy and financials out of the tech and semis. And we can see that today in the price action of mega cap tech, which has been trending really strongly now for months. Apple only came off 1% today, but Microsoft was down 2.3%. Same with Google. Amazon was down almost 4%. NVDA down 3.3%. Tesla was the big one, along with Meta as well, down 4.2%. AMD already underneath its 50-day VWAP, and quite the pullback in Netflix as well, 8.4% right down to its 50-day. And there was a bit of hard selling across the meme space today. Basically, the whole sector saw a good pullback, along with Coinbase down 8%, Carvana down 16.2% after it's been on a huge run, and others as well, like Beyond Meat down 9%. We also had earnings out today from railroad operator CSX, and they missed a little bit on their earnings and volume. The CEO did note that imports are slowing and destocking activity has continued. So this is a good measure of the health of the economy as they moving goods around. And like we're seeing exports fall in China, that means consumers are consuming less. And like I said, this is already happening at record low unemployment rates. What happens if those high rates do eventually kick in and hurt the jobs market when consumer savings are record low, their credit card debt is record high? So all that could be creating fertile grounds for the mother of all corrections. We had good results out today from healthcare companies Johnson & Johnson and Abbott Laboratories, beating on both the top and bottom lines, sending their stocks up. And a bit of a pullback yesterday after Las Vegas Sands reported. Continued strength in the financials with Goldman Sachs breaking out to multi-month highs. And those beaten down telecoms, AT&T and Verizon, just kind of hanging in there today. And other regional banks continue to do well. Western Alliance ticking up. Zion's up almost 10% after their earnings. And the other big guys still doing well too, like Wells Fargo and Charles Schwab up almost 3% today. There's a quick look at our S&P 500 oscillator, pulling back today to 56.4 and still on a strong divergence with the market. Okay, back into the market, S&P 500 still above 4,500. Wasn't much of a pullback here. Overall, just down 0.68%. It was more than NASDAQ, down 2.3%. On the back of those earnings from Tesla and Netflix, I don't really buy the argument the market was expecting a lot more out of them. They did increase a lot of their key metrics and gave pretty good outlook and guidance. I think it's just, like I've seen happen time and time again in the market, is the market will just use earnings as a catalyst and source of liquidity to kind of change their positioning and get out. And I think that's what we're seeing maybe finally here in mega cap tech after we've been on this really tight parabolic run almost all year now. Kicked off from the launch of ChatGPT late last year and that real surprise earnings coming out of NVDA a couple of months ago. And with that jobless claims coming in lower than expected today, showing the jobs market is still tight. The Fed's likely to keep jacking rates. We still don't know how high they're going to go, just maybe at a slower pace. And historically speaking, tech doesn't like higher rates, as tech stocks can be thought of long duration assets. And so long duration assets are always more sensitive to changes in interest rates. And so maybe finally tech is starting to take note of those interest rates, and the market could be just using this earnings period as a reason and liquidity to get out and reposition, or at least take profits at these elevated levels. However, like I noted in the volatility market, that's not really saying that we're in for anything spectacular although that can change really quickly, and would really need to see the NASDAQ close below that 50-day VWAP and our wave flow to go into red to really say we're in a short-term downtrend. For now, this could still be just yet another buy the dip opportunity. So we've got a bunch of mega cap tech earnings coming in over the next week, and we'll just have to see if we get those continued negative reactions to them and whether the NASDAQ can get into a short-term uptrend. And that may just be an isolated pullback in the tech growth high beta stuff, because we can see the strong price action in the financials starting to walk the line here, along with energy and defensive stuff like utilities starting to look a little bit better now as well and perking up a bit here. So for now, my target positioning is still market neutral. I'm finding it hard to lean strongly one way in this market to get either strongly bullish or bearish. There's good arguments to be made for both sides. There is improving breadth across the market out there, with increasing new highs, strong short and medium-term momentum. However, we have all those negative macro factors that I cover, and valuations versus bonds is still very elevated. And that's a wrap for today. Tomorrow is the third Friday of the month, which means that's regular options expiry, OPEX. Things can sometimes get a little spicy on OPEX. Will no doubt be a huge day on the options market, a lot of volume going into the close, and we'll see whether we can get a continuation of this pullback in mega cap tech, semis, growth, and high beta stocks. Thanks very much for watching, and I'll see you then.